Welcome to Analyzing Your Numbers. Today we're very lucky to have two guest speakers. First off is Fabielle from BDO. She's a manager with BDO where she provides financial advisory services. Fabielle specializes in business valuation, which requires the analysis and understanding of a company's financial performance in order to determine its market value. Fabielle obtained an Honors Bachelor of Commerce with specialization in accounting from the University of Ottawa and a graduate diploma in accounting from the University of Quebec. Fabielle went on to obtain her CA designation and is nearing completion of her Chartered Business Valuator designation. Very good, very excited. Definitely a professional on board here, so if you have any questions, we have her. As well as today we also have Greg from BMO. Greg has over 20 years experience in the financial industry, the majority of which has been involved in commercial banking. In addition to being a commercial banker, Greg is a certified general accountant and has a BCom specializing in finance and economics. His background also includes developing corporate analytical systems for merchant banking, portfolio and investment analysis for asset management, and data mining for an economic advisory firm. And even more, was also the VP Finance for a multinational firm based in Alberta, overseeing all aspects of budgeting, finance, treasury, and risk management. So as you can see, we have two great experts on board today. Welcome.
Thank you very much.
Thank you, Carla. So the goal of our presentation today is, sorry, I'm just having a bit of an issue with the slides here. There we go. So the goal of our presentation today is just to provide business owners with some tools to assess the financial performance of their business and to help the business owners understand which ratios are most important to financial institutions. Because we know that entrepreneurs are often so busy with day-to-day operations and that they don't have time to spare on complex financial analysis, our presentation is going to be limited to a handful of basic financial ratios, which we believe will be of most assistance in assessing your company's performance and the direction. So we'll discuss the calculation of some key ratios, the purpose of those ratios, and how to actually use them as performance tracking tools. Before I jump into those key financial ratios, I think it's important to understand the general purpose of the ratios. So you use ratios to evaluate the performance of a business and to identify potential problems. However, you should know that a ratio on its own is not of much relevance. If someone was to tell me, for example, that a working capital ratio is 1, then I wouldn't have enough information to tell you if the performance is good or if there's any problems that should be addressed. So when you're analyzing ratios, what you need to do is compare to at least two things. Either the past performance of your own company or compare that ratio to industry standards. So for example, if we look at the days of accounts receivables over multiple years, you can compare the rate at which the receivables are being collected. If there's a significant increase over a period or a significant decrease over a period, that tells you that there's a problem. So when I talk about that, it's mostly understanding that there's a trend analysis that needs to be performed. So it's not just about looking at what's going on right now, it's about looking at what happened in the future and how you progress and where you are at now. When I talk about the industry ratios, basically you want to compare your own performance to the performance of your competitors. So if you're realizing gross profit as a percentage of sales of 50% and all of your competitors at 40%, then you're doing something different that gives you that extra 10%. And you should be doing some extra analysis to determine where that's coming from. So if I'm just giving you a couple of ratios here, it's just to give you an understanding of the importance of the trends and the importance of the industry. As far as the ratios that I just touched on, I'm going to explain those in further detail as the presentation goes on. As you can see on the slide, there's a business performance dashboard. That's just a tool that we're going to discuss some more as we present. It just gives you an understanding of where your company is at. So to give you some type of analogy, if you look at your car when you're driving, you just look at the dashboard, you can see with just a quick glimpse how fast you're going, if your check engine light is on, if you have a flat tire, so if you need to stop and actually assess the performance of your car. So it's the same thing with that business performance dashboard. It's going to tell you if you're doing fine or if you actually need to take some time, stop, and deal with some issues. So that's the ideas to remember as we talk about the ratios. Remember that trends are important and that industry performance is also important. The first ratio that I'm going to present is the working capital ratio. That's being calculated by dividing the current assets by the current liabilities of a company. What that does is that it shows you to have enough short-term assets to cover your short-term debt. If you look at the table, there's a few examples of current assets and current liabilities. So let's say you have $100,000 in current assets and $200,000 in current liabilities. Then your current working capital ratio is 0.5. So if tomorrow you have to pay all of your current liabilities, you don't have enough current assets to do that. And that could be a potential issue. In the general guidelines, I mentioned that a reasonable range of working capital ratio is between 1.2 and 2. So just to give you a better understanding of that, if you have current assets of $200,000, current liabilities of $200,000, then your working capital ratio is 1. And that just means that you can pay all of your current liabilities with the current assets that you have on hand. The reason why there's a cap at the high end is that sometimes if you have too many current assets, it may just mean that you're not using those assets properly. So perhaps you could be doing some investments and you're not doing that. So to go back to the trends that I was speaking about earlier, if you see that you have a declining working capital ratio over multiple fiscal years, that could just be a red flag that warrants further analysis. So, for example, your company's sales volumes could be decreasing. As a result, your accounts receivables are decreasing, and that's just causing your working capital ratio to be smaller and smaller year after year. So to remember, with the working capital ratio, you have to look at the trends. If the number is smaller than 1, potentially it's an issue, but that's also depending on the industry that you're operating in. And a larger number is not always better because it could mean that there's other issues with your cash management. Moving on to the asset-cash ratio, this is basically the same thing as the working capital ratio, with the exception that the inventory is excluded from the current assets. So it just means that you're calculating how many assets or short-term assets you have, but only considering the assets that are liquid. So the inventory, you'd actually need to sell it, so you couldn't use that tomorrow to pay your short-term debt. The asset-cash ratio is perhaps used a little bit less by financial institutions because it is more conservative. However, it's a good measure as a business owner to track how your company is doing without taking into consideration the inventory that you have. The days of accounts receivable is another ratio, and it's being calculated by dividing your accounts receivables by your sales and then multiplying that by the number of days in a year. The purpose of it is to indicate the average number of days that a company takes to collect revenue after a sale. To give you a better understanding of what that means, it's simply if you have all of your clients paying their bills in 30 days, then your days of accounts receivable would be 30. So it tells you how many days it takes you to collect the money from your clients. The thing to keep in mind when you're looking at that ratio is if you, for example, require clients to pay their bills in 2 weeks, but then you're tracking your days of accounts receivable and it's actually 45. Well, then it tells you that you have a potential collection issue, and maybe you have some bad debt hidden inside of your accounts receivable, and that you need to do some analysis to figure out why those numbers aren't where you'd want them to be. When we look at your accounts receivable ratios compared to the industry, if your number is significantly smaller or larger than that of the industry, that could also indicate that perhaps your customers are taking longer to pay their bills compared to the industry. Maybe you're being too restrictive with how much time you're giving your customers to pay their bills. All those things are going to impact the performance of your company going forward. Similar to the days of accounts receivable is the days of accounts payable. So where the accounts receivable was how many days does it take you to collect the money, the days of accounts payable ratio tells you how many days it takes you to pay your suppliers. So if we go back to the trend analysis, if the number of days of accounts payable is increasing, that means that it's taking you longer and longer to pay your suppliers. And that could be an indication that you have cash flow problems inside of your company because payment is taking longer and longer. If that's the case, it could result in other issues. Your suppliers may decide to cut off credit to your company or start requiring some payment up front. So you just want to keep an eye on the days of accounts payable ratios in order to determine if you have any cash flow problems. Another way to use the days of accounts payable ratio is to compare it to the days of accounts receivable ratio. So ideally, if you want to avoid any cash constraints, the days of accounts receivable should be less or equal to the days of accounts payable. In doing that, it just allows you to ensure that you receive the payment from your clients before you have to pay your suppliers. So to put numbers to that, if you collect the money in 2 weeks and you have 30 days to pay your suppliers, then it just allows you additional time to avoid any cash flow problems.
Thank you, Fabielle. I'll talk about the next 4 slides. The next 2 deal with total debt to tangible net worth, and all of these ratios that we've been talking about, that Fabielle has talked about, and the 2 that I'm going to be talking about, these are more than just important to entrepreneurs and businesses because banks and other financial institutions, they do look at them. And by understanding these ratios allows you to respond to questions as they come up. The total debt to tangible net worth is one of those key ratios that financial institutions, if they're lending to the business, are going to be tracking. And the reason why it's important is it tells not only the business, but anybody making loans to the business, how much debt that business has, and is it financing its assets by way of equity or heavily on debt? And the calculation is adjusted. It's not just debt to equity. Most financial institutions need to make adjustments because there are things that may not be showing up in liabilities or may be showing up in equity that maybe don't belong there. For example, when we look at the total adjusted liabilities to tangible net worth, total adjusted liability starts with all the liabilities of the business. That includes current liabilities, long-term debt, anything that shows on the balance sheet. But there are some things that show on the balance sheet that really are not liabilities. For example, future taxes. That's more of an accounting adjustment that reconciles the difference between tax accounting and normal accrual accounting. So it's really not a debt, and most of the financial institutions will back that out from the liability portion. Another side, another item that will be adjusted out of total liabilities will be debt that is is, for example, shareholder debt. And there's two ways shareholders can, well, there's many ways that shareholders can put money into a business. One is by injecting it directly by equity. Another way is, and you see this a lot, is owners will loan the money to the business. And often they'll say, well, it's still equity, it's still my money in there. So, so in order to make the debt look and smell like equity, we have to have it subordinated. As a financial institution, if I'm lending to them, it has to be, number one, subordinated to the bank. It should be assigned to the bank and fully postponed. And what this means is that the shareholder says, by signing this documentation, they say, we will make sure that our money stays in well beyond the banks. We'll pay back the bank first. You can treat any loan as equity. And often there are ways that banks can still allow the owner to pay himself back, either interest or principal, and that's usually outlined in any commitment letter, saying that we allow repayment of the shareholder loans, notwithstanding that they're subordinated to the bank. We'll allow them to be repaid so long as certain covenants that we may, and these go back to those ratios, are adhered to. On the tangible net side of the equation, it starts with the equity of the business. That's any paid-up capital, contributed equity, or retained earnings that accumulate in the company. What we add to it is, again, that debt that was postponed and to the bank. And so we'll treat that as equity. Things that then need to be removed from the equation would be intangible assets. Things that, for example, goodwill. It doesn't have value to anybody other than the owners. If the business ever had to be liquidated, or you had to look at what tangible assets are in the business, it would exclude those items. Also, trademarks would be another intangible that you wouldn't be able to necessarily, and people will argue it. Some trademarks, in fact, can be sold, but to a financial institution, generally they don't have any value, so they would be excluded. Other items that would be deducted from the tangible net worth side would include advances to related party. And the reason this is owners can bypass some of the calculation by, instead of paying out dividends, they simply loan themselves money. It's still money that's leaving the company. It's still value that's being paid out and no longer represented within the company. So if the company loans money or invests into other related parties, maybe the owner has another side business and they want to invest into it, that value has been effectively stripped out of the company we're talking about and moved elsewhere. So those are deducted from the tangible net worth side of the equation. So what you end up getting is a ratio, and that ratio provides a lot of individuals in the understanding as to how much, and we call it leverage, how much leverage is in the business. The higher the leverage, it is associated with more risk. The lower the leverage means it's more equity finance, means there's lower risk. And the reason that there's a difference is debt comes with an expectation of payment. Equity does not. So if the business is experiencing some fluctuation in cash flows or in sales, if it's all equity, if a business owner is financing the business 100% equity outside of maybe some trade payables, but it's all their money in, if sales are down, even if they have a small loss, they're not going to have anybody knocking on their door asking for payment of a loan. They will have their trade vendors, their suppliers asking for payment, but they won't have a financial institution. It could be a lease, it could be a loan. Nobody's saying that you still have to make those principal and interest payments. So the higher the equity, the lower the risk. Conversely, the higher the debt, the higher the risk, because it is again, there is an expectation that principal and interest will continue to be paid. So that's why banks and financial institutions really do concentrate on this ratio. Under the rule of thumb is under 2 to 1, gives banks a little bit of comfort that the company is well capitalized by equity as well as debt. When it starts getting over 3 to 1, actually 2.5 to 1, financial institutions become a little bit concerned. And there could come a point where if the company is experiencing losses, for example, you may find that the retained earnings start to accumulate negatively and wipe out any of the equity that may have been put into the company in the first place. For example, if a business started off with $1 million of equity in and over the next 3 years lost $1.5 million, effectively it's negative equity. And at that point, the company is fully, more than fully, financed by debt holders, whether it's suppliers, whether it's a bank, whether it's a leasing company. And at that point, the owners, outside of sweat equity that they have in there, they don't have any dollar invested anymore because it's been wiped out. And at that point, it becomes technically insolvent, and you never want to see a situation like that. That's when the ratio actually goes negative. So financial institutions and business owners should watch this, if nothing else, to make sure that they are managing the risk in the business. That's simply by way of who's financing the assets is being managed properly. And this will be discussed by financial institutions if you're dealing with those. The next ratio I'm going to talk to is steps away. It's a counterpart to the leverage. This looks at the amount of cash flow the business generates. When businesses are open, it's always the expectation that it will generate profits. The profits that can go towards, in the end, paying the owners either a good salary or dividends. But before they can start paying out dividends and reaping the rewards of ownership, they have to at least make good with those principal and interest payments on the debt, on the capital leases, any of the debt that's there. So this ratio is looked at when financial institutions are lending to the company to finance long-term assets. And that's when you get a mortgage, when you get a long-term loan, or maybe amortized over 20 years, you will have a payment stream, an expected payment stream. And that payment stream needs to be covered, first and foremost, by the cash generated by the business. When the business can't generate that cash, then it opens up the question, how is the business going to repay these loans? So the calculation, just to go into the calculation, is the numerator is cash flow to service that debt. The denominator is debt obligations. So the cash flow to service the debt starts with the net after-tax income. You add back the interest expense. And the reason why you add back the interest expense is because we're trying to get, in the numerator, trying to get to the cash flow that was available prior to making the interest payment and the principal payments. So you add back the interest because it's already been deducted from the net after-tax income, and we're trying to get to that pre-interest after-tax cash flow. You also add back non-cash expenses. The reason being is we're trying, again, to get back to how much actual cash flow is being generated by the business. So we add back things like amortization, depreciation, and future taxes, because, again, that's not a cash flow item. The cash tax line is, but future taxes isn't. So that gives you a very basic indication of how to calculate cash flow to service debt. There sometimes are other adjustments, but they're very they usually don't come up. But that gives you your standard definition. The debt obligations comes basically down to principal and interest payments, capital leases, and sometimes dividends. And the reason sometimes dividends is the company may have, for example, issued preferred shares to a certain class of shareholder and be obligated to make certain payments of dividends. We're trying to get back to what are those debt obligations, or actually just cash obligations of the business, and compare that to the cash flow that the business is generating. So if we turn to the next slide, you see, you take a look at some of the rules of thumb. The rule of thumb is a ratio of less than 1. What does that tell you? It tells you that the business is actually generating less cash flow than its obligations require of it. So if the business has, say, $10,000 of principal and interest payments in a year, it should at least generate $10,000 of cash flow from its operations. If it doesn't, then the question is, where does that cash come from to repay the principal and interest payments? Well, that generally comes from the liquidation of assets or from the shareholders injecting more money. And the liquidation of assets could be even just liquidation of current assets. For example, if they had a large buildup of accounts receivables at the end of the year and then collected it over the next year, it may have found that that was where it made up the difference. But it's not sustainable because eventually the accounts receivables will be collected and you get back to the situation of how much cash flow does the business generate. A larger number for a bank or a financial institution indicates lower risk. So when it generates more than, a good rule of thumb is at least 1.25 to 1, that tells the financial institution that you can at least cover your principal and interest, maybe specific dividend payments that are required by the business, and still have some money left over to reinvest in the company. So ideally, you don't want to be operating at just 1-to-1 because eventually you're going to have to reinvest in the company, maybe buy more machinery. There's going to be other capital expenditures that you may have to spend on the house, on the building, on equipment that might be capitalized and not expensed. So if you're only at 1-to-1, you're not leaving sufficient cash flow in the business to make sure that you can grow. And I think the goal for any entrepreneur and any businessman is not just to cover their debts. It's to generate enough cash flow that they can grow their business. So by managing that ratio, and then ultimately managed by knowing how much debt you have on the books, how that debt is structured, and being able to successfully operate your business to generate the cash flow, by doing those things, you can ensure that you have enough money left in the business at the end of the year after paying your principal and interest payments to then either reinvest into the company or, for example, maybe pay yourself a bonus or pay yourself a dividend. But you don't want to be stripping out all the money in the business because financial institutions will say, well, if you stripped out all the money in the business, where's the future growth going to come from? And that's something that's worth tracking.
So when I started the presentation, I spoke about the business performance dashboard. We explained to you that there are ratios that can be used to track the performance of your company and identify some potential issues. And on the other hand, there are also some ratios that are used by financial institutions to do those same things, assess the performance of your company, and determine how much financing may be available to you. I want to go back to the business performance dashboard now that you have an understanding of some of the key ratios. What you need to remember is that this is a tool that will help you get a picture of what's going on in your company. So the business performance dashboard doesn't need to include the ratios that we presented today. It's going to be specific for each different company, and it should include those ratios that you feel are relevant for your specific business. It should be brief enough to fit on the one page so that you can just look at it quickly and see if there are any trends or any differences between your company and the industry that should be investigated. I presented a template on this slide, so it gives you three columns of ratios that are pulled from your own company. The column to the left is your historical data, and I just presented the 1 year here, but that could go back 3 to 5 years so that you can actually identify any kind of trend. And then you have your actuals, so what's going on right now. And then if you want to be proactive, you may want to do some projections, so what's going to happen next year. And that may be of assistance when you are speaking with financial institutions. If the information is available, you can also compare how your company is doing to how the industry is doing. So your competitors who should likely be in the same product and the same size, maybe the same geographic area would also be more helpful. There's different ways to obtain the industry information. You can get that from Statistics Canada has some of the information. Greg, you mentioned a couple of
there's a company called Robert Morris in the United States. They still produce good industry numbers, more U.S. based, but it still gives you a good indication of, because it's ratio driven, where the numbers should be, and they also break it down by way of size of business. So if you're a small business saying, well, I'm not going to compare to a large multinational, they do break it down by size as well.
Yeah. So all of those, if you don't know where you should be, that type of information is going to help you get a better understanding of maybe where your company should be heading or what kind of ratios you should be aiming for. Did you have anything else to?
Well, I think what business people may be asking themselves right now is, ratios are nice, but I operate on a cash basis. I know where I am at any one time. Why do I need to track these things? And there's many reasons why it's a good idea. And in the end, you may not use the ratios that are shown on the dashboard. You need to tailor it to your business and what's important. I'll give an example. I had a client who managed a business. There was a restaurant component and another component. And in the end, he wasn't there all the time. He hired a general manager to manage the business for him with the expectation that it was operating fine. What ended up happening is the general manager was approving payroll expenses, overtime, not sending people home when they didn't have the business that day. They could have, a lot of the staff were wages, so they didn't have to, they weren't committed to a number of hours in the day, and those decisions were not happening. So when this happened, they actually had a loss that year, largely because of this. Now, the owners who said, well, I'm going to be more on top of it, but had they been tracking, for example, in this case, payroll costs to sales, they would have recognized that they're spending much too much on payroll to generate $1 of sales in the business. And by keeping track of that ratio would have been a way for the owner to know that decisions were not happening the way he wanted, and he could have stepped in earlier rather than actually incur a loss that year. So that's one of the reasons why it does make sense to generate this. It has to make sense for your business. The ratios that you may want to track may be very different from the ratios that the business across the street wants to track. You have to think about your business and what makes sense. And but looking at the industry ratio numbers, comparative gives you a good indication of where you should be. The other source, of course, is your financial institution. They have access, and in your discussions with them, you can simply ask, where should I be for certain of these ratios? What are you looking at? And having a better understanding of what your bank is looking at allows you to manage those expectations. Usually the hardest thing to deal with is when your financial institution, could be even a capital lease company, comes to you and asks about a ratio and you're not quite sure what they're talking about. This allows you to have a better understanding of what their expectations are, what's important to them, and if they're a source of your debt capital, then as a result, it's going to end up being important to you as well to make sure that those relationships can be managed. So that's my 2 cents.
Thank you. So, Carla, perhaps you just want to open the floor to questions now and take it from here.
Perfect. Okay, so I'm going to